So if you're thinking about buying a new car in 2025 or later, you need to hear this. There's a new federal tax deduction that could save you thousands of dollars on your car loan interest. It's available whether you itemize or not. But here's the catch. Not every car qualifies, and there's a specific rules you need to follow to claim it. In this video, I'm going to break down everything you need to know about this deduction, who qualifies, which vehicles are eligible, and exactly what you need to do to make sure you don't leave money at the table. Let's get into this. All right, so I have 4 slides here that's going to provide a little bit more context to this deduction here. So how the deduction works. You get to deduct up to $10,000 per year in your auto loan interest on qualified passenger vehicle loans. It applies to new cars, SUV, vans, pickups, or motorcycles assembled in the US. So that's key. So if you're looking at a car, you want to make sure that its final assembly is in the US. When you talk to the dealership, they'll be able to let you know. The vehicle must be for personal use, not business or fleet, and refinance loans may not qualify for up to the original amount. All right, so who can claim it? So you got to look at your adjusted gross income. So if you pull up your 1040 from your 2024 tax year, look for adjusted gross income. Now, the true definition is modified adjusted gross income, which has a slight different calculation to arrive at that amount. But for this presentation, just pull up your 1040, page 1, and look for the line that says adjusted gross income. And if you're single and your adjusted gross income is $100,000 or less, or if you're married, file a joint return and it's $200,000 or less, you get to maximize that deduction of the interest. So if your auto loan interest was $10,000 and you fall below these income limits, you'll be able to deduct the full $10,000. Now, what happens if your income is more, right? So if you're married and you file a joint, and just say your income is $205,000 and you had a $10,000 loan interest, what happens? What happens is every $1,000 where your income is beyond these limits here. So in this case, your modified adjusted gross income is $205,000. So you're $5,000 more than the limit here. You have to reduce the loan interest deduction by $200 for each $1,000. So in this example, you're $5,000 over. So 5 times 200, that's $1,000. So instead of being able to get the $10,000 deduction, now you'll be able to get a $9,000 deduction. So at some point, you're going to be phased out completely for some of you, and you won't be able to use this deduction. So now's the time to kind of think about planning, right? So if you're around these limits or just above it, now's the time to kind of start thinking about this, especially if you think about getting a car. Again, this only applies to individuals, no businesses or related party loans. All right, so what you'll need to report, you must include the vehicle's VIN on your tax return, and lenders must report total interest paid in vehicle details, year, make, model, and VIN. So what's going to happen is the dealers are going to report something to the IRS and they're going to send something to you. So when you report this interest on your tax return and you file it, the IRS is going to do their due diligence to make sure everything matches. Now, 2025 tax year is the first year, and the IRS is offering this transitional relief for lenders where they can just provide you with a basic statement to you that that shows the interest and all that information. It's not a formal tax form, informational tax form that they need to file. So that's just for 2025. So when does this apply? So this applies for tax years 2025, 2026, 2027, 2028. The loans must be incurred after December 31st, 2024. So that means in 2025 or later. And again, only for new personal use vehicles, no deduction for leases